Before diving into this topic, here is the most important truth you need to know right away, in a clear and honest way. There is no real nationwide stop using your credit card order, and there is no official blanket rule created by a 9-0 decision of the Supreme Court of the United States that bans credit card usage or suddenly changes how ordinary people must spend money. However, there are real and very important tax reporting rules enforced by the Internal Revenue Service that affect how credit card activity can be interpreted when it is connected to income, business transactions, online selling, freelancing, gig work, or payment processing systems. And the reason this topic has become so widely discussed is because modern financial life is no longer limited to cash and simple bank transfers, but instead involves complex digital systems where credit cards, payment apps, online marketplaces, and third-party processors all interact with tax reporting frameworks. And this creates confusion that often leads to exaggerated claims online that make it sound like credit cards themselves are dangerous or restricted, when in reality, the issue is not the credit card, but the way financial activity is categorized, reported, and documented under tax law. And to understand this properly, you need to think of a credit card not as a taxable instrument, but as a financial tool that records transactions. While taxation applies only when those transactions represent income or deductible expenses under existing rules, meaning that everyday personal spending, such as buying groceries, paying for fuel, shopping online for personal use, or paying household bills with a credit card, does not create tax liability. But when that same credit card is used in connection with earning money, such as buying inventory for resale, paying for services that generate business income, receiving payments from customers, or managing side hustle activity, then the financial trail becomes relevant to tax reporting and must be properly documented so that income and expenses are accurately reflected on tax returns. And this is where many misunderstandings arise, because people assume that if money moves through a credit card, it automatically becomes taxable, which is not true, since taxation depends on income classification rather than payment method. And the IRS primarily relies on reporting systems like Form 1099-K and other third-party information returns to match reported income with financial activity, meaning that payment processors, online platforms, and financial institutions may report aggregate transaction data when certain thresholds are met. And while credit card issuers themselves do not typically report every individual purchase to the IRS, the ecosystem surrounding credit card payments increasingly falls under reporting frameworks designed to improve transparency and reduce underreporting of income, especially in the digital economy, where individuals may operate small businesses from home, sell goods through online platforms, or provide freelance services without formal accounting systems. And this is why the topic of credit cards and IRS rules has gained attention, because the system is evolving toward greater data matching and automated verification, which means discrepancies between reported income and third-party data can trigger notices or questions from tax authorities even when there is no intentional wrongdoing. And this is not a new tax being imposed by the Supreme Court or any sudden legal shift, but rather the ongoing development of enforcement mechanisms that already exist within tax administration law. And it is important to emphasize again that the Supreme Court of the United States does not create tax reporting systems like Form 1099-K, nor does it regulate everyday consumer credit card usage in the way viral headlines often suggest, because its role is to interpret constitutional and statutory law when disputes arise. And while it may decide cases involving taxation or financial regulation, those decisions are typically narrow in scope and do not create sweeping lifestyle restrictions. And the reason misleading narratives spread is because financial compliance rules are complex and often misunderstood, especially when they involve terms like reportable income, third-party settlement organizations, gross receipts, net profit, and information returns, which sound technical but essentially relate to whether money earned through economic activity has been properly documented and reported. And this becomes especially relevant in the modern world, where individuals commonly engage in multiple forms of income generation, such as freelancing, e-commerce selling, affiliate marketing, ride-sharing services, food delivery platforms, and digital content creation, all of which can involve credit card payments either directly or indirectly. And when these activities are combined with personal spending on the same financial accounts, it becomes easy for records to become unclear unless proper bookkeeping practices are followed. And this is where IRS enforcement focuses, not on the credit card itself, but on inconsistencies between reported income and actual financial flows. Meaning that if a person earns income through a platform that reports earnings to the IRS, but fails to include that income on their tax return, the discrepancy can trigger automated review systems. And those systems are designed to identify mismatches at scale rather than to target individuals using credit cards. And another important aspect is understanding how deductions work, because many people using credit cards for business-related expenses may be eligible to deduct those expenses from their taxable income, but only if they maintain proper records and can demonstrate that the expenses were ordinary and necessary for their business activity. And without documentation such as receipts, invoices, or categorized statements, it becomes difficult to support those deductions in the event of an audit. And this is why financial organization is emphasized by tax professionals, not because credit cards are restricted, but because credit cards generate large volumes of transactional data that must be categorized correctly for tax purposes. And in addition to income and expenses, there is also widespread confusion about credit card rewards, cashback, and points, which in most cases are treated as rebates rather than taxable income, meaning they are generally not subject to tax when earned through personal spending, although nuances can exist depending on how rewards are structured or used in business contexts. But the general principle remains that rewards are not treated as wages or income in the traditional sense. And this further shows that credit cards themselves are not inherently linked to taxation, but rather serve as tools that can either simplify or complicate financial tracking, depending on how they are used. And in today's financial environment, the IRS increasingly uses automated systems to cross-check data from banks, processors, and employers, which means taxpayers are more likely to receive informational notices when mismatches occur. But these notices are not automatically penalties. They are often requests for clarification or correction. And understanding this distinction is crucial because many people interpret any IRS communication as a serious enforcement action, when in reality, it may simply be part of routine data verification. And the overall goal of these systems is to improve compliance accuracy in a large and complex economy, rather than to restrict consumer behavior, such as using credit cards for everyday purchases. And when discussing claims about new rules, it is essential to recognize that tax law evolves through legislation passed by Congress, administrative regulation by the IRS, and judicial interpretation by courts, including the Supreme Court of the United States. But none of these processes suddenly outlaw common financial tools like credit cards. Instead, they refine reporting thresholds, clarify definitions of income, and adjust compliance mechanisms to reflect changes in the economy, especially the growth of digital commerce. And therefore, the idea that people must stop using credit cards is not supported by actual legal framework. But what is supported is the need for awareness about how credit card usage intersects with taxable activity, particularly for individuals who mix personal and business finances. Because without clear separation, it becomes difficult to determine which transactions relate to taxable income and which do not. And this is why financial advisors often recommend using separate accounts or cards for business purposes, maintaining organized expense tracking, and reviewing monthly statements carefully to ensure accurate classification. And while this may seem like extra effort, it is increasingly important in a financial system where reporting is more automated and less reliant on manual review. And ultimately, the strongest and most accurate takeaway from this entire discussion is that credit cards themselves are neutral financial tools, not tax triggers, but the activity conducted through them can become relevant to the Internal Revenue Service when it involves income generation or deductible expenses. And understanding this distinction removes unnecessary fear created by misleading headlines and replaces it with practical awareness about how to stay compliant in a modern digital economy where financial transparency is increasing. And by focusing on proper record keeping, clear separation of personal and business spending, and accurate reporting of income, individuals can use credit cards safely and effectively without concern about imaginary bans or exaggerated legal claims, while still meeting all obligations required under current tax law. And this is the real message behind the viral topic. Not a prohibition on credit cards, but a reminder that financial systems are interconnected and require responsible management to avoid confusion or reporting errors as digital transactions continue to grow in volume and complexity.